and you will be learning that it between two parties. One is called the dealer, and one is called a company or a person. There should be some time. It means the date is involved and some exchange rate is also involved. Okay, after some time, it can be a 1 month, 2 months, 3 months, 1 year, right? Okay, you decide that after 3 months, okay, I will buy this currency from you after 3 months at this rate. So the rate that you decide with this, and remember, this is a contract. What contract means, you sign the contract and fulfillment of the contract is obligation. It is backed by law. It is enforceable by law. So you enter into a contract that I would buy, for example, this is a yuan over dollar. Right now it is 7. I would buy from you dollars. After 3 months, the rate is 7.1, right? So this rate that you mention in contract, we call that forward rate, right? So the market that you deal with this, or you find this kind of structure, we call that forward market. So important point here is that forward market is over the counter market, which means it is a market which is customized to your needs. And what does it mean by customization? Just give me a minute. I come back after just a minute.
Sure, sir.
So customize mean according to the customer needs. If you want 1 month, the dealer is ready to give you 1 month contract, 2 month contract, 4 months, after 6 months, after a year, after 2 years, whatsoever according to your needs. It means these are not traded on stock exchange or currency exchange. Currency exchange, right? So forward are customized according to your needs, and it is not readily available for many of the individuals. For companies, yes, but not so many individuals because it should be customized. If you want to ask, okay, I want to buy $200 after 2 months, the bank will not give you this rate. If you want to tell them, okay, I want to buy $200 million after 2 months, and bank would be interested, right? So for like wealthy individuals or companies, because companies transaction is more than 200 million or $2 billion like that. So you understand the forward contract? It is the agreement between two parties, the dealer and the company or a person, that they would enter into a contract with the set rate, currency rate, which we call that forward rate, after some time. And since this is a contract, it is obligatory by law. If sellers, what happened? This is the contract rate. So what happened? If after 3 months in the market, the rate goes to like 7.3, right? You would be benefited. Why? Because if you did not enter into this kind of arrangement, then at that time you need to buy the dollar at 7.3 yuan per dollar. But now since you contracted with this, the dealer is entered through contract, so he should be obliged to sell you dollars at 7.1. What if it is 6.9? Then it is your loss, because seller will say that whatsoever in the market, you have to buy from me at 7.1 because that is our contract rate or forward rate. Understand?
So in what scenario would we sign a forward contract?
Another thing, so we must pay something for the contract, right?
We'll talk about in our coming classes. We have like one whole chapter on forward, one whole chapter like on future and on options as well, right? At this point, let me just give you a little, you can see the taste that when we use this forward contract. For examples, can I use okay, I have an option here, whiteboard here. You are in China. Okay, now let's talk about the book example. You are in US. You buy from China goods or some plants or machinery whatsoever, right? Does it happen, this kind of trade happen in one day? Answer is no. At least it take 1 to 15 days, or sorry, 1 to 30 days. After CPAC, it would be like 1 by 1 to it would be 15 days. It takes 1 month. If it's a plant, big plant, then it takes 90 days for delivery, right? Your goods will be transferred to you after 90 days. High-tech machinery or the goods is 30 days. And you transfer the money right now or after 30 days? Sorry, after 90 days. Sorry. So your contract has happened now at point 0. Contract is, sorry. Contract has happened at 0 and delivery and the payment is after 90 days. So your planning is that right now, sorry about my coughing. I really apologize for that. Here we go.
It's okay.
So after 90 days, the money going to be transferred or you will be receiving your plant. So you're a big company, and in big company, there are managers who plan, right? Who organize, who plan, who control also the cost as well. And they mentioned that right now we base our analysis whether this machine is, is affordable or is profitable for us or not. They find out that $1 is equal to 7 yuan, and the machine cost $10 million. It means in yuan it is 70 million, right? And after 90 days, the exchange rate is 7.5, right? So they plan at the start that our machine that we have to pay $100 million, and that would be 70 million. And now due to exchange, what happened? The exchange rate increased, and now you, for example, that, okay, I made a mistake here. Okay, you find out that that machine is $70 million, right? And at that point, 70 million is equal to 10 million, according to this point. But now the exchange rate has gone up, and now the machine is still 70, but how much you have to pay extra due to this increase? When you convert this money into this, you can convert your dollar into yuan. How much dollars are now needed? That is yuan over dollar. How much dollar needed? Guys, answer me. Just need to divide. 10 million. 10 million divided by 1.5. And 10 million divided by 7. Point. Here we go. Due to increase in the value of yuan, now what happened? You, for example, you saved $1 million here at point zero, and after 90 days, when exchange rate increased, you have to make a payment of $70 million. Then how much dollars are needed? It means approximately $3 million you need to pay more, right? We call this risk. And how we can manage the risk, we call that through hedging or hedge. Michael, your answer. So in order to avoid this kind of stuff, a mismanagement in planning, so we hedge. What if it is 6.9, still we are paying 1 million to the seller? If we take this example, if we gone through this kind of forward contract, then extra these 33 million and $33,000 will be paid by the dealer. If it's 6.9, your machine is still cost, come on, your machine is still cost you $1 million, sorry, $10 million. If rate goes up, extra will be paid by the dealer or the seller of the forward contract. If it is less than $1 million, then it is still cost you $1 million, and the difference you will be paying to the dealer, right? So it's a win-lose situation, or you can say that not win-lose situation. The result of this situation is win-lose, but for you, it's a win-win situation for the company. How? Because your planning is good. So that is a big, the foremost priority of the financial manager is to plan the finances accordingly, right? The accountant responsibility is to control the expenses. So if you cannot, if your planning is interrupted, then all of your accounting is disrupted, and you would say that, okay, I planned well, and due to my accountant, he didn't control the expenses. So this kind of like mismanagement occur between these two departments, the treasury and the account budgetary department. And what happened? Mismanagement happened, and at the end, this will cost us huge in our market reputation, also our share prices as well. Plus, in annual general meeting, you will be removed from your position as a finance director or financial manager, because in real sense, the price just increased to 33%. Sorry, it's just 0.5, but when you just multiply it with 10 million, look at the massive scale of $3 million you extra cost for that one. Michael, you got my idea? Michael, you here?
Yeah, I kind of get it.
Okay, when we talk in detail regarding the valuation of future and forward.